Hi, welcome to our next topic, which is about understanding market cycles. So, before we start with the topic, here is a disclaimer. I am not a SEBI registered advisor, and the content here is for educational purposes only. So, what are market cycles? So, Wyckoff developed, Richard D. Wyckoff in the early 19s developed a framework which focuses on supply and demand through four phases of market. So that is accumulation, markup, distribution, and markdown to predict future movements by studying volume and price action. So this is what is market cycle. So based on Wyckoff theory developed by Richard. So what all we will cover today? So we'll cover what is market cycle, the different phases, why it exists, and what this means for us. So one of the biggest mistakes I made early on was thinking that market should always go up. So when it fell, so I got confused and it kept falling. So I felt anxious. So I assumed so this might be the same scenario with many of you. And when it finally recovered, so I realized something important. The market doesn't move in straight lines, so it moves in cycles. And once you understand that, downturns stop feeling like a disasters, so they start feeling normal. So today I want to show you how market cycles actually work and why understanding them changes the way you invest. So they are like natural rhythm of expansion and contraction. So that is how market rises and falls. What is a market cycle? Okay, so market cycle is simply the natural rhythm of expansion and contraction. So just like the economy moves through growth and slowdown, markets move through optimism and fear. So no market rises forever, no market falls forever. So there is a quote I deeply believe in. The four most dangerous words in investing are, so this time it's different. So every cycle feels unique, but the pattern repeats. So what are the four phases of market cycle? So they are accumulation, expansion, distribution, and decline. So you can see like where is that accumulation phase happening, so where is that expansion phase or markup phase, so where is the distribution phase, and where is the decline phase or a markdown phase. Okay, so usually what happens in accumulation phase, so there is a panic and market slows down, price start moving sideways, so public sentiment is negative. But what is the most important thing that happens in this phase is institutional start buying. Okay, so this happens quietly after a downturn. So what happens, the panic is slowly coming down, the market stop making aggressive new lows, price will start moving sideways, public sentiment is still negative, but institution begins accumulating, smart money begins buying while most people are still fearful. So how can we say it? So if you see my chart here, so this is what I call as an accumulation phase, because accumulation phase is quiet. So there is no excitement, there is no media hype. In fact, most people are still skeptical, but beneath the surface, long-term investors are slowly building their position. So this usually happens after a crash, but before a big rally. So that is where the accumulation phase is. So what it looks like, you can easily see the market is in sideways trend. So there is low volatility, low public interest, but big people are slowly buying. So this is where they enter. So if you see Nifty example, after the sharp fall of 2020, the market consolidated before starting a strong rally. Okay, so you can see how price stops falling but didn't explode it, and this is what we call it as an accumulation phase. Okay. So the next one is expansion phase. As I already told you, mark up phase. So what happens here? So there is a huge confidence that grows, prices move steadily. So this is a trend phase, and there are more participants in the markets, and this is happens as a structured movement. I will also show you a chart to show this, like what happened after accumulation phase, and the trend becomes clearly visible, so there is no confusion, but it's not vertical like completely 90 degrees. So there is a structured upward movement, higher highs, what it looks like, higher highs, higher lows. So there is a strong earnings growth, so increasing in the investor confidence, news become positive. So this is where disciplined investors often ride the trend. So they don't chase it, they ride the trend. So this is an expansion phase, and this confidence builds for the investors, and more participants enter during this phase, and also optimism grows. This phase it is easy to figure out by every participant because this will also always be in the news. So what is the other phase? Similarly, like accumulation, there is another phase which acts in a similar way. We call it as a distribution phase. What happens here? Smart money slowly exits because they know, so there is no upper another higher highs are forming in this place. Price stops making new high, and slowly momentum will keep down coming down, but retail investors are very optimistic because they have pre-seen the trend phase, but institutions they will slowly exit. So this is kind of an excitement peaks because everyone is optimistic. People believe prices will only go higher. So this is often where the risk increases the most. So we rather than distribution phase, we can also call it as an euphoria phase or a late stage excitement. Retail participation will increase in this phase because they assume so this will never fall. So this is a kind of a sentiment that they have, and there is a huge media hype happens around this phase. Yeah, but what institutions will do? Slowly they will exit their positions. So you can see, so this is a distribution phase, so that is happening. So there is no higher highs, but slowly institutions are coming or closing their positions. So which is the next phase? Next phase we call it as a decline phase, or here the selling accelerates. So there is negative news and it increases. There is retail panic and prices keep falling down. Most of the support level breaks in this phase, and this is emotionally very intense because decline feels very sudden, but structurally it often begins during distribution phase itself. Fear replaces optimism and selling feeds more selling. So this is the phase where you need to be very careful, where your emotional decision matters a lot, and where you need to maintain your risk reward and risk management very properly during this phase because this will be very fast. So what happens in this phase? Early investors they start selling, so negative news begin appearing everywhere. Fear replaces greed, then the cycle resets. Fear creates opportunity and optimism creates risk. During distribution and decline phase, smart money exits and fear begins. So let's compare the four phases what we just saw now. You can see like what is the phase and what is the sentiment. So what type of price action is happening. So who are the key participant? As I told you in accumulation phase, so the sentiment is very negative to neutral, and price action is always sideways or range bound. Who are the key participants here? Institutional investors. And what happens in markup? Sentiment is very bullish, people are very optimistic, price action is steady uptrend. And who are the participants? Retail and professional traders. What happens in distribution phase? Sentiment is euphoric or a mix because everyone would have ridden the bullish phase or uptrend phase and they are not ready to give up, thinking that the market is still going up. So what happens? Price action. Market is a sideways and key participant. They are early sellers or usually the late buyers. Markdown phase, panic or bearish, price action sharp downtrend and key participant all the panic sellers. So why this four phase version is better? Because it is very clearer, less emotional language, more structural, easy to teach, easy to apply and more professional. So you might be thinking why this cycle exists. Because we are humans and humans are emotional. So we usually swing between fear and greed. So when the market rises, confidence increases, and when the market falls, fear takes over. As Warren Buffett said, be fearful when others are greedy and be greedy when others are fearful. But that's easier said than it's done. But when fear is everywhere, it feels very, very rational. But slowly, time changes everything. So it changes all the perspectives of the market. Let me show you something powerful. If you look at 1 month chart, so during a downturn, so it looks terrifying. But if you just zoom out to 10 years, that same downturn may look very small. So that is what I mean. Perspective changes emotions and long-term charts reminds us markets historically moved upward over time, but they don't move it very smoothly. So there are a lot of hiccups that happens during that up move. So what this means for you as a beginner, so understand the market cycle, understand how the cycle changes behavior. So instead of panicking during decline phase, you prepare for them. So instead of chasing during euphoric phases, you manage your risk. So you stop asking yourself why is this happening and start asking so where are we in the cycle and what you need to do in the cycle, so which phase it is, which is the best way for you to invest. So that shift alone makes you very calmer and well prepared, because the most disciplined investors don't try to predict every phase perfectly. So they prepare for all the phases because cycles are not failures, they are the features of the market. So once I stopped fearing downturns and started respecting cycles, my decision making was improved. So that is what understanding market cycles will teach you. Yeah. So you need to know like how to be disciplined, what you need to do in a which phase. Yes, so that is where you are learning as a beginner step by step. If you have any questions, you can post it to me. And thank you. Um, Kindly like and subscribe to my channel. So as more subscribers, I'll be talking about different types of markets